Good afternoon, ladies and gentlemen. Welcome to the June edition of our strategy meeting. And for those who might be new to us, this is where our trading team gets together and we talk about some themes that we may be seeing over the coming month or coming weeks, if it will. And we're going to bring in Brett Manning to start things. And we're going to do things a little bit differently than we have in the past. And what I hope to do is have an open dialogue with everybody, kicking around different ideas, some thoughts, pros and cons about the different themes that we may be seeing. And Mr. Manning, chart trader, how are you?
I'm doing pretty good, Jim. How are you?
I'm doing quite well. So we tend to start with you because you bring that global macro analyst to the table. And what we're seeing in the market, we've talked at length about the disconnect between the market, the stock market, and the data that we've seen. We've seen the Fed. We've got that upcoming Fed meeting in just about 2 hours or so. So we have a lot that we can really digest here, Brett. So why don't you just give us a little input as to where you are on the markets, what you're seeing, and maybe a little expectation from the Fed.
Okay, so first off, I think policy has been an enormous part of the picture right now. But I push back a little bit on the idea that this is about the Fed. I actually think that it's about fiscal policy stimulus starting to take really kind of the front seat in this process, and that's around the world. Recently, there was research out showing that we've seen 10 trillion in total announced fiscal stimulus so far this year versus just 8 trillion in total monetary stimulus around the world. So central banks have been doing more than they ever have in the history of markets, but fiscal's done even more. And so I think that separate this out. What the Fed did was really, really important in early and mid-March because they put a floor in corporate credit and corporate access to credit by basically saying, we're going to make sure that you're going to get through this no matter what. And a big part of that was a lack of moral hazard coming in. And I said that about a month and a half ago, and I got some pushback on it from subscribers and colleagues. And I think that the differentiation is what I meant was moral hazard wasn't a policy consideration in this case. Sure, there will be moral hazard from what's happening, but moral hazard wasn't an overriding policy consideration in the same way it was, say, in 2008. In 2008, we let Lehman go. We let Lehman go because they said, and it was obvious, and everybody who knew more about this knew more that this was the case, that they basically said there's a 95% chance that our big bets are going to work out. There's a 5% chance that they don't. And we're only going to make a little bit off of those bets because we're dealing with a sort of, tight markets at this point. We're picking up pennies in front of the proverbial steamroller. But if we leverage 350 times, we can turn that into a big gain. And our analysis shows that if it turns out that it's that 5% outcome where these things don't work out, then we're too big to fail and the Fed will just bail us out. And it became very clear, I think, to everybody that was the idea. So if we bailed them out, a year later, we just have 10 more Lehmans because everybody would start making that same bet, and it would lead to complete implosion in the financial space and everything else. The whole credit system could be under fire just because we would reinforce this pattern of behavior. So the Fed really had no choice. They had to let Lehman go. This time around, even companies with really conservative approaches in terms of leverage were at risk of failing in early March. It didn't really matter. It was just basically if you weren't an e-commerce company, you had the possibility of going bankrupt. It didn't really matter what your pattern of decision making was in the past. The way Gavin and I talked about it is it's kind of like this is an alien invasion. What do you do in that case? You don't really worry about the moral hazard. So the Fed was able to just say, we're going to take absolutely everything onto the balance sheet. That was really good in setting a floor, but I think that accounts for maybe about half the rally that we've seen. The other half of it, I think, is the fact that we've seen this $10 trillion in fiscal stimulus start to step in. And the argument that I would make, and it really kind of concerns me about the long term, once we have let the genie out of the bottle on this, and I think this is a little bit of what the market is starting to see, where is the restraint? Where does the restraint come in when instead of don't fight the Fed, what about don't fight the White House? If we can go ahead and do this, we're willing to just go ahead and keep on creating this money. Anytime we find an excuse, we're going to be sending out another $350 or $500 billion in cash. This is the helicopter drop, and we've done 10 trillion of it already. What's to say that's going to stop when economic data normalizes, particularly in an election year when you've got the electorate used to the idea that they can get free checks. Like I think that that's going to come into voting behaviors. There's somebody who pushes back on that idea, maybe kicked out of office. That is a bad system. That's a bad feedback loop to start to put in place. And I think that the market is seeing, well, you've got to worry about, look at the jobs report we had the other day. People were wondering whether or not we'd start to see some hawkish language come out from anybody at all involved in the stimulus engine that we're really riding right now. Because it was just this surprisingly good employment data, but of course we didn't, right? We're not quite back to the point where you maybe really would worry about that yet, but really, who in a position who's writing that $10 trillion check is really going to start wanting to take the punch bowl away, particularly at this stage as we start to approach the election. So I think that you've got this new dynamic involved, and it's a bigger punch bowl, and it's a harder punch bowl to remove, and it's a more powerful punch bowl. We talk about the voodoo doll magic idea. This is the pin. This is the knife in the shoulder. This isn't the pin in the voodoo doll. This is very direct application of cash to the economy. So I think that that's a big part of what we're seeing as far as the extended upside, kind of pushing this cash out of money market funds and into riskier assets, is because you're not going to see that hawkishness start to come into the picture, not because of asset prices, not because of improvements in the economy, because the engine has flipped in terms of the real stimulus pushing things from the monetary side to the fiscal side. So that was the main point that I was making in our notes in our conversation before this conversation.
So, Brett, my question would be then, if that policy agenda is in place, and to me, I get the sense, have you seen the movie Brewster's Million? Do you remember that one with Richard Pryor?
Yeah, of course. Oh, sure.
Okay, so this is what it's beginning to remind me of. I want to buy your vote. And so the fiscal policy will still be in place, at least until the elections. We get the result of the election. So it sounds to me that if everything stays in place and we get no hint that the Fed is going to tap the brakes at all, because there's at this point no reason to, assuming everything is the same, we're status quo there, then we probably have a lot of upside until at least November, probably into January. Then all bets might be off.
Well, unless we start to crash right after the election. I mean, you could.
Well, that's why I was
tighten that up a bit once the votes are in.
Right. Well, I was, trying to paint the picture of the window where we're at least till November, sometime between then and January would be probably where the risk is. And who knows, maybe the fiscal stimulus kind of carries over into the holiday season. Everyone's feeling good, and we close near all-time highs or wherever. And then come January, in that time frame, that window of end of Q4, beginning of Q1, things could really stay in place as is.
Now that is a reasonable extrapolation from the argument that I made, and I had the same conversation with somebody yesterday. So yes, obviously though the virus is going to come into this a lot. We have seen a series of things. I posted something last week that outlined a series of really positive developments in terms of research for the virus. I think that's also part of what's driving things. The low K value that I talked about, in other words, like 10% of people are responsible for 90% of the spread of the virus. That's a really important and positive thing, because it suggests you really need super spreaders in a super spreading mass event to really keep the kind of outbreak going, and it's not going to happen quite as much from the grocery store or getting a haircut or something. So that's really important and positive. Much lower K value than the typical flu. Immunity appears to be working. In other words, if you get this, you have antibodies. The antibodies are effective. That also bodes really well for a vaccine. The contagious window is shorter than we feared. That's been a really important development. Maybe you got 7 or 8 days where somebody is contagious, whereas we thought initially, as of a couple months ago when we were really crashing, there was some data that suggested it might be as much as 35 days, which is a really scary idea. And we also have a marker to identify severe cases early on, which means it's more likely to develop coping treatments over time. So there's been a lot of really good developments over the last maybe 3 weeks. If you survey the peer-reviewed research, you can see that there's kind of this gradual unfolding of concepts as we learn more about this that suggest that it's not quite as awful as we thought. And I think that that's a big part of what's happening too. That will also come into play in terms of how the market reacts in the aftermath of stimulus.
I also think, though, Brett, that if we did get a second wave of the pandemic, isn't the Fed and fiscal policy still armed to combat that? We just go right back into the mode in which we were, and then we saw the result.
Sorry,
Which,
restate your question.
well, the question was, if we did have a second wave of the pandemic, we saw what the actions that were put into place. Why wouldn't they just be able to do that again and just carry us on to the next round?
Oh, yeah. Well, I mean, I think unquestionably, again, you have the same issue about moral hazard and the same infinitely large resources. So,
Well, I would
clearly.
say one thing. This is event trader here. I think the difference is if we get that second wave, a lot of the initial buying was done around the reopening process and the linearity comments that we were seeing from some of these people that were putting out their earnings. And that was a lot better than feared. At some point, that's going to lose some of its steam. And I think in particular, if we see a second round of, a necessary shut-in at all because of that second wave, I think then, we talked a lot about the bridge that the Fed was trying to build across in order to get us to that next level. I think they've done that for now, but the longer we see that chasm kind of spreading, and if we don't see the economic data bounce back faster, then that's slowly going to seep its way into the economy, and we're going to slowly see that start to really impact earnings. I don't think that's something that the Fed can necessarily gloss over. What the Fed did was shore up the liquidity markets, but they can only do that for a certain period of time, in my opinion. I know if you're watching, for instance, Gunlock's piece last night on Double Line, where he was talking about the second wave being that 100,000 white collar jobs starting to burn down if we aren't able to see hiring come back on and demand in the real economy start coming back. And, that all of a sudden takes out a big investor here and a lot of 401ks that are being put into play. That slowly starts getting taken out of the market. So I don't think that the Fed could necessarily just gloss over a second round of economic setbacks here. I think they've done a good job at filling the gap right now, but there's only so much of a gap that they can fill. The other thing on top, too, is I think you do have to be watching the elections here. I know Goldman had a note last week, I think it was, talking about the rising chances of a blue wave election. And not saying that would necessarily be bad for the markets, but the reality of it is that we're going to need to find a way to pay for some of this fiscal stimulus. And one of the things that Biden's been talking about is taking back some of the corporate cuts that President Trump put into play. That's obviously going to cut into earnings, and that would further hurt some of the valuation potentials in the market there. So I think we've gotten a good boost from liquidity and from better than expected economic data, but we know the market's a forward-looking instrument. If towards the end of the year we're not really seeing that bounce back in jobs, that bounce back in economic data, and we just saw these couple of months really be kind of the low-hanging fruit, the easy bounce back from an abysmal number. And, we're still going to be well below, say, the 2018, 2019 numbers. At some point, that's going to be reflected in the stock market. So I don't think, again, that the Fed could just gloss over this on a second round of stimulus.
I got one response, one main response. I push back against the idea that people are going to start worrying about how we're going to pay this back. I really do. I really kind of see it as almost an absurd conversation at this point. It's going to take a lot of electricity to run the printing press.
Yeah,
That's how it's going to be paid back. It's not going to be tax cuts and austerity and working really hard, and 50 years later, by putting a penny in the jar every year, we're going to pay this back.
Yeah, but I do think that there will be the push to have corporates paying for some more of the social programs there. And
Sure.
And in that route, I think that they'll be looking to raise taxes. So, I think the printing press would work for a while. Or it's not even really a printing press, right? It's more of a software program at this point. But I hear what you're saying, Brett, with the
I just mean the argument about
modern
austerity
monetary
being an issue,
theory.
I think, please.
Yeah, no, but I mean, Biden's already said that he's looking to raise taxes on corporates, right? So I don't think that whether or not I don't think that's going to be enough to fill the gap, but I do think that's going to be some way that they're going to be looking at on the other side of the aisle to see how they could kind of ease that gap a little bit from the numbers that we're seeing right now. And I
Sure.
think it's something, and I think it's something that the stock market will have to take into consideration.
I grant that there's political risk, and I really wasn't making my initial kind of statements there about the glorious future ahead as much as to try to help people maybe understand why we have seen the kind of run that we've seen and how aggressive it's been. I feel like the market is looking around the corner to some extent in terms of the size of the punch bowl that's in play right now, and that it's not just about the Fed, and that it's the type of punch bowl that's not going to be taken back as quickly.
Yeah, no, it's certainly evident. I mean, we've been talking a lot about the last week with some of these distressed plays that have just been taken off. Hertz, Whiting Petroleum, JCPenney's, all these bankruptcies that are just flying now. I'd be curious at Damon's thoughts on this area of the market, because I know he spends a lot of time in that distressed area. I know he was playing, I think it was Hertz he tried playing earlier. So, Damon, you got any thoughts about the money that we're seeing flowing into some of this distressed areas and how you would maybe be playing it?
Well, it seems like they're. Can you guys hear me okay?
Yes, sir.
Yeah, I hear you fine.
Yeah, so it seems like a lot of people are still at home receiving unemployment, and they're at home trading stocks. There have been record account openings at the online brokers, and it seems like a popular pastime over the past few weeks is to see which stocks have shot up the ranks at Robinhood in terms of coverage or intraday trading. And you've seen a lot of these speculative bankruptcy types of plays being traded at sites like Robinhood. So I think you just have a new large retail participation in the market right now. So it's kind of interesting. It would be kind of interesting to see what happens when people go back to work. And secondly, I mean, at some point, this is going to start to fizzle out. I mean, we've had huge gains off the lows. There were things that looked attractive last week that no longer look attractive. So I would imagine that some of these new traders will start to experience some frustration in terms of things not just going up every day. So I mean, it's so it's been fun while it lasted, but yeah, I don't know how much muscle this thing has left in it. I still think that you have large enough crowds of new retail investors to kind of keep some of this intraday momentum going in some of these smaller names. So definitely worth keeping on the radar for just these massive squeezes I would still be looking for opportunity in some of these smaller names, especially ones that have a big run up and then a multi-day pullback of say 40 to 60%. I think there's a good chance you can catch a nice squeeze off of some of those names of 40, 50%, which is what I was trying to do with Hertz this morning. Had a big run over the past couple of days, started to pull back aggressively yesterday, gapped down this morning, kept declining. I was looking to try to play that dip, that reversal. You're actually seeing that play out well in a bunch of other names. Hertz popped a little bit, but you're really seeing the bounce more so in some of the oil services names, some of the smaller finance names that are seeing bigger bounces off their early lows.
Well, we got golf coming back this weekend, Damon. Do you think a lot of the talk's been people who are in DraftKings playing the markets here, and if any of you guys have a thought on this, do you think we see some of this liquidity and some of the beat down names dry up as people could go out and go play DraftKings again?
It's a good question. I mean, I guess that possibly, but I think the big thing will be when people go back to work. I mean, right now, there are a lot of people who are, like college students, for example. I have a neighbor who came home from college and early and decided to open a day trading account and become a day trader. Just had a lot of free time on his hands.
How's he doing?
So I think there's like a lot of people out there looking with a lot of free time, looking to try to make money in the market as they start to go back to work. And I mean, I guess you probably get more recreational stuff on the weekend, so it's probably not as much of an issue. during the trading week. But yes, it'll be interesting to see how it plays out.
Yeah, don't forget the habitual gamblers who had no place to go for the last couple of months as well. All the casinos have been shut down. And, they probably opened up these accounts and they got a taste of the stock market, and the timing was just right because you didn't really have to be short on anything. You just had to buy it, and they've doubled or tripled their money. You talk about anybody that bought, Norwegian cruise lines down and single digits, they doubled their money. You talk about, any of these beaten down retailers, they've doubled their money. Airlines they doubled their money. So they've gotten a taste of, almost a false taste of how easy it is to make money in the stock market. And they're going to be hanging around for a while. I'm curious to know if the numbers, how big the numbers are when Vegas starts opening and all these other casinos start opening. And, would people actually leave and go back to play a game where the house has the edge on every single game? Or are they going to be more interested in, hanging around the stock market and actually, educating themselves and, trying to, play this game here instead?
Can I add one more point? Just
Sure.
one more point to tack onto this before we attribute the entire rally to new day traders, which I know you're not trying to do. But I just want to make sure that people also understand over the last 5 days, we've seen a huge closeout in short positions by hedge funds, and we've seen $16.7 billion come out of money market funds, probably a great deal of it moving into risk assets, including equities. So you're seeing that there was a buildup of pessimism over the course of this rally to a certain point, and I think when we started to break above that last range and break above 3,000, we've started to see a lot, and also reopen, and start to see some of this improving information about the virus and the likelihood of it becoming a really serious issue again. I think that a lot of those big bear bets have started to come off the table, and a lot of money, which you can call a flat squeeze, a lot of money that was just sitting under the mattress, has started to come back into a more normal level of exposure to equities.
Yeah, I feel that was really highlighted, Brett, when you were talking about that move in the yen, dollar, and gold. What was 2 weeks ago? That kind of signaled this latest leg up. So, no way would I be attributing this move purely to somebody that got a $1,200 stimulus check at all or anything like that. But it's obviously a lot of the hot names, as Damon was saying, and like that people were looking at Robinhood just to kind of track these down. This is what
Absolutely.
A lot of the intraday traders are playing. I got a question for you and Scott in terms of the charts on moves like this. I mean, how do you interpret charts? Are you using them at all for levels that you're trading off of, or is it just kind of throw that all out the window and just look for trends?
Brett, do you want to take that first, or should I?
Go for it.
So of course, I can't do anything without my charts. It's like a map for me, going down a road. It's impossible for me not to look at a chart. The numbers mean nothing if I don't know where a support level is or a resistance level is, or how the price action behaved, or if an entire sector is moving altogether, what's the trend up or down. I'm in the camp that says, big money, big institutional money, big portfolio management, they move markets. They're the ones that actually, they're the part of the, that they create trends, basically. And for me to not use a chart would just be, trading blindly. For example, the great point in case here was last Friday, we had a big gap up on the earnings report, on the job data, and we saw airline stocks just gap up significantly. And I don't know how anybody could sit there and buy an airline stock knowing that they had already run 5 days prior about 35-40% on average. And then they gapped up on Friday another 14-15%. I mean, to me, to not look at a chart and know that group has already been hot and just buying it on the opening there would just be foolish. So, yeah, I think their opportunities are there. I wouldn't say it's trickier. I mean, the VIX is still pretty high, around 27, 28. And so there is still that wide and loose, fast trading range where this is a great environment to really kind of be a little bit more short-sighted in your trading. Because the moves are going to come, you're basically getting more bang for your buck. but I think it's still absolutely critical to really kind of focus on the charts to identify relative strength, relative weakness, where the money is rotating. And I think that's been a huge theme here over the course of the last 2 months, is just rotation, rotation, rotation. They love energy, they love airlines, and then all of a sudden they're flipping to industrials and financials, and they're flipping back into heavy tech, and then it's just kind of coming around, and it's coming around, and it's in this like circular motion here. So as long as you can identify those rotations and the charts are revealing them in their patterns, I think there's a lot of money to be made here.
Yes, Scott, you make a good point about how the rotations have been really important with the cyclicals and the secular growth stocks going back and forth, and there's actually this website that tracks the Robinhood activity, robinhoodtrack.net, and I guess we should start monitoring this a little bit closer. But you can look at a leaderboard and popularity changes, and it's not really surprising. The leaderboard is, for GE, AAL, DAL right now, a lot of household, low-priced, big names. And then the popularity changes are just like these momentum stocks. Number 1 and 2 right now is VRM and NKLA, so just the, new hot momentum stock. So it's not really surprising, but it's probably worth keeping an eye on it just to kind of track all this, I guess, novice hot money is flowing.
Craig, how have you been seeing the tech valuations the last couple of weeks? I know we've had some fluctuations, had a small pullback, but it feels like the last couple of days they've been moving back on. Has anything been sticking out to you with regards to that?
I mean, they're just, sort of out of control, stratospheric. If you're looking at enterprise software names, they're just through the roof. But again, like I noted yesterday, if you look at mega cap tech, which has obviously been kind of leading the way these last couple of days, you can make the case that those stocks, that there's a reason why people are piling in, because they're not egregiously priced. I mean, a lot of these high growth software companies that are growing 50%, you got to pay 20 or more times sales. But when you look at the FANG stocks, they are, they're not cheap, but 20, 25 times cash flow, considering their generally strong outlooks and dominant market positions. It would make sense that they are sort of defensive right now.
Google's still pretty relatively cheap, isn't it? I thought I saw something where it was like trading at 16 times.
Yeah, and the regulatory overhang is pretty significant right now. Apparently, there's a lot of state attorneys generals that are looking to make a move. But yeah, I mean, the mega cap tech, and I caught the end of Gunlock's double line presentation yesterday, and he basically was saying how the FANG mega cap tech stocks have accounted for almost the entire gains that we've seen in the S&P 500 over the last 5 years. If you take out mega cap tech, the outperformance relative to the rest of the world, which is basically flat over the last 5 years, it's pretty much just mostly mega cap tech, which is pretty startling to see, but I guess not too surprising.
All right, so I got a question for the group. It seems like the big thing we've been seeing from people is what's left to buy here. You kind of get into that bullish rotation where first we saw the COVID winners rallying, and then the next was the cyclical names on the thoughts of reopening, and now we're seeing a lot of the bankruptcy names, which could raise a red flag. It certainly suggests an end to this current cycle potentially. But is anybody out there seeing any value or any names that they think have another leg up? Scott, I know, for instance, you had mentioned something about the healthcare names in a nice consolidating pattern. Maybe go around and throw out a few segments or areas that you're watching for if we're to see another leg higher, where you think it might come.
Yeah, so let's take a step back about a month. And a month ago, biotech, the ETFs, IBB, XBI, BBH, they were all making strong moves to new all-time highs. And that was basically very significant because if you take a look at a monthly 5-10-year chart, you can see that these biotech ETFs have really been in somewhat of a sideways range. And this new all-time high movement is basically a very bullish signal from a long-term technical perspective. So with that in mind, obviously things got a little bit too far ahead of themselves, coming off the rally from the March lows, April lows, and then up to those May highs. So they just needed to take a little bit of a breather. And I think that's what we've seen here over the course of the last 4 to 5 weeks. You could take a look at, say, like a weekly time frame. And you can see that that chop has been going along here along those highs. And if the theory of sector rotation holds true, in a bull market, they should be looking to rotate money back into this biotech arena sometime soon, I think. Maybe you're starting to see momentum slow down a little bit from some tech to various degrees, although they are diving back into mega cap tech recently. The NASDAQ just broke 10,000, for the first time ever, so you have that sort of relative strength going on there. And so biotech is really kind of a major player in that group as well. So I think it's just a matter of time before they start plowing back into biotech.
I have a couple ideas. Typically when you get this type of devastation in a market, IPOs tend to be a good place to look, and you're starting to see that. We've had a couple deals come this week that have done really well. So definitely one place to keep an eye on, the new deals. The market likes new paper after everything's really run aggressively, and doesn't seem like there are a lot of attractive valuations. So definitely keep an eye on the IPO market, the next big thing page as well. Another area that's starting to kind of generate some interest, and I could definitely see some of this new novice retail money taking note, is some of the SPACs, like the special purpose entities that are created to go out and buy public companies. And so I just bought one a little while ago just because I came across it, wasn't familiar with it before this morning, but it's called Flying Eagle Acquisition, and it's the same group that put together the draft. Is
there a ticker for that, Damon?
The ticker is Frank Echo Apple Charlie, and the one that I bought is the FEACU, which combines both the underlying stock and the warrants. So once these guys cement an acquisition, they'll break the stock up into just common stock and warrants. And so actually I had warrants in the DraftKings deal, and I think I made like 300 or 400% on those. So these guys have a good track record. It's a good time to buy a company, just given the economy. You might be able to get a deal, especially like, for example, a company that had planned to go public up until the stock market fell apart, might be enticed to do a deal with someone like Flying Eagle, where they can do essentially an IPO without all of the cost and get a little hype surrounding it, just given the notoriety of this group. What is the SPCE, the Virgin Galactic, whatever, that was one of those SPAC deals as well. So they're starting to get, somewhat get a little popularity, notoriety. And I think you could, it might be an area of interest to find some under the radar opportunities.
Yeah,
Damon,
Damon,
go ahead.
So another SPAC that came out a month or two ago was IPOC, which was the follow-up to IPOA, which became Virgin Galactic, SPCE. And
IPOC, Craig?
Yeah. IPOC.U, I guess, would be with the warrants. I'm not getting IPOC to pull up, but IPOC.U is pulling up on my charts.
Yeah, it's pulling up.
Hitting a new high today.
How's the liquidity in these?
Not great, I don't think.
Yeah,
but
So the process for these companies is basically it's just a dead stock until they do a deal. So I think I was involved in my first SPAC maybe it's probably 7, 8 years ago, and I was in an oil play. A bunch of oil executives put together a deal. They came out and bought I think it was a midstream company. It might have been upstream. Got it really cheap, and the stock ended up probably going up 150%, but the warrants went up dramatic. I mean, the warrants were, I don't know, it might have been up like 1,000% or something like that. So with these deals, I like to play the warrants in particular, just because they just move more. And what's nice about these deals is that they typically price around $10. The combination of the stock that has the combination of the underlying stock and the warrants typically price around $10. Once they announce a deal, I think you have a window to basically reject it. So you can ask for your money. Well, I mean, you could just sell the stock at $10 or whatever, because they typically stay around $10. But even if it fell below $10, on most of these deals, give you the ability, say for a 30-day or 60-day period, to basically just request your money back if you don't like the deal that they've put together. So, so essentially you tie up cash. I mean, because I think they usually have like a 2-year window to get a deal sealed. So you potentially are tying up cash for up to 2 years, just kind of waiting on this thing to happen. I know that, that's happened to me before, where I've been in one of these things for probably over a year waiting for a deal to happen. So you have to keep that in mind.
Yeah, I think the Virgin Galactic took like a full 2 years almost. It was pretty close to 2 full years. But like you said, there's some downside protection there, which is pretty nice.
So basically,
I would think that. Can I just make a point? If tying up capital is really the only downside of this kind of situation, wouldn't it be much more likely that these companies would raise much more capital during a period when interest rates are basically zero?
Yeah, and so I think the guys who did the DraftKings deal, I think they just did another one, the one I just talked about, Flying Eagle. I think they raised $600 million, which might have been their biggest one.
That makes sense.
And I think it's their 6th deal that they've done.
So Damon, I'm curious. I don't recall you talking about this on the site. Is this something that I just missed, or is this something that is so new that you're just kind of getting your feet wet? I know you've done it, 8 years ago, but is this a kind of a newer idea that you had that you're going to be implementing more and more as the months progress?
Well, SPACs historically have not had a great track record. You have companies that come out, put them together, tie up your money for 2 years, and then buy some garbage company, and the whole thing kind of unravels. But so with the space, whatever, Virgin Space, whatever holdings deal, I think that got the area back on people's radar, and then to follow that up with the DraftKings deal, I just think that it's gained enough popularity that, and especially with all these new retail investors in the market, that if you put together a compelling deal, people are going to bid it up, and they're not really going to pay attention to valuation, et cetera. But there was a big gap in terms of a big window between the compelling deals I've seen. I mean, it's a multi-year window. So that's why I haven't really talked about it that much. And I just took a flyer on the DraftKings deal just because I thought it was interesting, just that theme. And I bought the warrants and really just kind of sat on them and forgot about them. And they were just, just sitting on them for 6, 7, 8 months without really paying attention to them. And they just took off. And then once the market corrected, the warrants got hit, and I was able to buy them again. I think as more information came out about the DraftKings deal, and obviously you've seen what the stock has done since it moved from the SPAC ticker to the new DraftKings ticker and officially debuted.
All right. So before we talk about the potential risks that we all may see in the market. I want to make sure we get out any other ideas from you guys before we step away into the economic and market risks associated. So, Gavin, do you have any other ideas that you wanted to toss out?
Yeah, I mean, we were talking about IPOs earlier, and I've been talking about this Vroom IPO, VRM. It's pulled back now to a more viable level. It had run away a little early here, and we're seeing some of that speculative money coming out. So that's definitely on my radar. It's an e-commerce platform for used vehicle for the used vehicle industry. We've seen Carvana perform extremely well. I mean, people simply loathe dealing with car salesmen. And, I think that this is going to be a pretty big space. We've heard a lot about people looking to drive into work now rather than taking public trans. So, not everyone's going to be in a position to just go out and buy new cars. So the idea of buying used cars is going to come in pretty handy here. And one of the things we talk about, we've been talking about Hertz and their bankruptcy. One of the things that they're going to have to do to raise cash is sell off a lot of their fleets. So VRM, I'm assuming, is going to be able to jump in there and build up their own inventory on the cheap by just buying these cars for pennies on the dollar off of Hertz. So I think VRM has a pretty good outlook over the next couple of weeks or next couple of months. And then also BETZ, BETZ, which is a sports betting and iGaming ETF. It's pretty well diversified. DraftKings is their largest position. It's about 6.5% of the ETF there. But, they got 41% of their companies in on online betting. 25% is actually on technology, which could go cross-board on a number of different areas. And iGaming makes up 16%. And they're also pretty well diversified on the geographic front too, so you don't have that risk of perhaps some sort of bill coming out of Congress that would shut down some of these betting sites. And with states scrambling to generate revenue, I think we're going to see more and more open up to online betting. So BETZ, the expense ratio is a little bit higher than I would like at 0.75%, but I think it's an area where you could see a nice cyclical play over the next 2 years or so.
Gav, you know my theory on themed ETFs, right?
What is it exactly?
They're always late to the party.
Yeah.
So they come about because there's usually a very strong demand in the individual stocks themselves, and then people recognize there's no ETF out there to play it, and so by the time they get all the paperwork done and the time they get the regulators to approve on it and everything else that goes along with that of introducing new ETFs, they roll it out. The stocks have already basically made their majority of their parabolic move. And you just go back in the history of this, where the most recent one was the marijuana stocks. They just absolutely took off a couple of years ago. They introduced the MJ ETF. Within a couple of weeks, they all just lost all their momentum to the downside. And you can just look at any sort of themed ETF. I know it's a theory. It's a theory, by the way.
I haven't seen any of these names run up $200 like Tilray and come back down.
That's true, but DraftKings is the hot one, obviously, and I would say that has gone a little parabolic lately with a 300% gain in 2 months.
Right, and that's the biggest holding. But I think that there's a lot of upside. Again, there's a lot of diversification here. So, this one just came out about 2 weeks ago. So, it hasn't run away at all or anything like that.
I know. Just keep that in the back of your mind, though. That's all.
Yeah, I think you both make good points. This DraftKings obviously has been a monster. Valuation seems a little stretched at this point. I like the theme longer term, but maybe it's worth letting it cool off a little bit to buy a lower. But like Gavin said, it's pretty well diversified. I think DraftKings is the biggest, but only like 6% of the ETF, right, Gav?
Yeah.
Yeah.
So I would just support
the entire ETF around DraftKings move.
I would support Scott's theory, though, for going forward. This is Brett, chart trader, as an applicable way to think about things. Themed ETFs are, generally speaking, in my experience, born into tragedy. because they come into existence at the point where the underlying holdings have become so exciting that they've spurred the existence of the ETF.
And
Yes.
that reminds me a lot of Bitcoin futures, Brett. Same thing happened.
Absolutely.
So yeah, I think that marked the all-time high in Bitcoin back then, a couple of years ago. All right, any other ideas you guys want to toss out?
As
I
a
would just
general,
say this is,
Go ahead.
maybe Trend might not necessarily recognize that we're in that point of the cycle where he tends to really shine. So I'd really pay attention to his IPO analysis, because you're going to start to see deals come to market that are going to be super compelling, because we've had this type of market action over the past month. Prices should be a little bit lower, which should create upside opportunity after stocks begin trading. And particularly if we see another aggressive pullback, you'll see valuations come down accordingly. And so definitely keep an eye on the IPO market. I mean, there's going to be some real, I think, compelling opportunity in there over the next 2 to 3 months.
Yeah, that's a good point.
Add, let me just jump in real quick, Craig, just because I want to echo what he just said. But there's a theme that Damon has covered a couple of times, and again that I think you can abstract out, which is a basic idea of market inefficiency due to sort of broadly defined concept of distressed assets. The IPOs are going to be cheaper. There's going to be assets that can be picked up cheaper, particularly if they're not well marketed. So any big balance sheet that's well mobilized and able to kind of really scour the environment, the balance sheet is going to be the source of value and the source of growth. Where the capital's accumulated, unless we get some kind of big antitrust movement and reform at the FTC, there's going to be a lot of the richer get richer, the rich get richer and richer, because you're going to have a lot of small businesses that basically can't handle this environment for one reason or another and don't have the support they need and are going to exit into a larger balance sheet that's really able to withstand the volatility and look at a really long-term time horizon. And I think the IPO theme he just covered fits into that as well.
Yeah, the problem with these hot IPOs is, the same kind of issue that you run into with the software group, that you kind of just have to plug your nose and buy them. We saw with Zoom Info ZI last week open up 100%, immediately sold off, and I had a good entry, caught a nice little trade in it. But it's since run another 20 points. I mean, I don't know if anybody's looked at this one, but it's just a great example of what's just going on in the broader market here. The value, these momentum stocks are just primed to just take off, even right out of the gate. If a company, ZI, I think they're growing revenue almost 100%. They're profitable, so it just checks all the boxes, and I'm sure there are going to be a lot of compelling IPOs. I've caught a few over in recent months. I still have a small position in that Inari, which is a hot medical device company, and it's basically done the same thing. It gapped up 100% from the IPO price, and it just keeps going. So it kind of speaks again to the theme of maybe just having to hold your nose a bit, not being too focused on the valuation, other than knowing when something is going to get bid up, I guess. One other thing I guess I wanted to put on blue chip Scott's radar. I agree. Biotech is interesting here, and obviously I kind of focus on more of the stock specific stuff. The XBI has kind of just been flat here for the last month or so, and one that I've been highlighting a lot, one that I've been in for a while, is AXSM. It's kind of starting to break out of a recent downtrend, but if you look at the weekly, you can see it's a very volatile stock. And
Is this the peanut allergy play? Or?
no, this is a depression drug
Okay.
that they're going to file. So there's really no more um, for the main indication. The data's out. They're going to apply for the drug in Q4. It's a small float, highly shorted stock. Management hasn't been dumping the shares. The valuation is pretty attractive, and unfortunately, because of the pandemic, the depression market is going to be even bigger and hotter now. I mean, it always has been a big market, and it was growing in and anything neurological, central nervous system has always been hot in biotech. So a new depression drug would have been a big deal even before the pandemic, and now
even more.
There's
so.
even more. Yeah, there's even more reason to like it. So I don't know.
Unfortunate.
It's starting to kind of break out of this little recent downtrend after filling this gap. So you might be you're a better person to kind of know to time it. I'm already in it, but
I think it looks great above $70. Let's put it that way. So again, technicals, you always try to find your risk first. I see some pretty decent support the last 2 weeks around 70. There was a gap that went back a couple of weeks ago. It was also a gap from December of 2019 that came in right around that $70 area. So it seems like the $70 level is a line in the sand over the course of the last 7 or 8 months or so. On a weekly time frame, you also have a doji week last week where basically the close was pretty much equal to the open of last week's, but it was also somewhat of a reversal bar as well off that 70-ish support level. So granted, it's been on the slide the last 3 or 4 weeks, as you said, with the biotech sector as a whole just kind of consolidating for the last 4 or 5 weeks. I think, if somebody wants to play an individual name, the float's a little small for my taste. I mean, it's like less than 30 million. I think about 10% of that's short. I usually don't like to go after individual biotech stocks because I don't like to, I just find they're too risky. And you're usually waiting on one phase 3 trial to, come through, to really kind of make a killing there. So I do prefer to go more towards the ETFs and get that variety and that diversification and whatnot. But yeah, if you like the story there, and again, Craig, you're one of the better researchers when it comes to these biotech. So if anybody wants to play it, I would definitely take a closer look at it.
Yes, I certainly understand wanting to avoid biotech because it is its own animal in a sense. But one of the good things is that there really isn't a ton of data that's going to be coming out. So it is a late stage, pipeline, sort of a de-risked asset in a sense. So
cool. Good to know. Yeah, it looks great above 70.
What was that ticker again, Craig?
AXSM.
Oh, okay. Yeah, you've been talking about that one, right?
Yeah. I've been on it, but
you could type it in. You could type that in the search box, and you'll see. Craig has quite a few notes on this stock over the last couple of weeks.
Craig, have you looked at any of the biotech deals that have come out recently? I mean, I don't know that there's probably been, probably 6 to 8 over the past couple of weeks.
Yeah, there's been a ton of them, and I haven't looked closely at them. I probably should go back and figure out which ones are. I mean, there's been a lot of them that have, I think, done well. So, I'll have to go back and look and see if there's anything that is really compelling, or either on a pullback, or maybe if it has pulled back. So,
Craig, here's a quick question for you. What would make you get out of the stock?
AXSM?
Yeah. To the downside, what's your risk parameter? Obviously, if it breaks higher, you can peel some off. That's the easy trade. What's the difficult trade? Is what would make you change your mind on this?
Well, that's part of the reason why biotech is so risky, right? We could have some bad news tomorrow morning that could just completely destroy the investment thesis. This is one that I bought in at somewhere near 50. I can't remember the exact price.
Yeah, but during the March crash.
Right, and especially in biotech, sometimes you have to, separate the extreme volatility in the stock from the investment thesis. So as long as fundamentals are still in place, then any significant weakness is a pullback. But there's a number of pieces of potential news that could come out tomorrow morning that would say, oh God, that could gap the stock down to 30 or something like that. If there was some issue, some kind of fraud allegations. I mean, I guess you could say that about any stock.
Yeah, maybe a covered call or something like that. If somebody's option savvy, they can protect themselves and whatnot. So.
Yeah. I mean,
right, cool. So you're waiting for the story you're basically waiting for the whole story to change, something detrimental, company altering.
Right, and you know how I kind of view things from a long-term fundamental investment perspective as opposed to
Yeah.
So if it pulled back to 50 without anything else changing, it's a buying opportunity. I think I said yesterday, if it does, I don't expect it to break below 60 again, barring some negative news. But at the 200-day, I think if it does, if the broader market pulls back, then it is a buy down there. So
cool. Yeah, for me it would be more. I would get, if I was to get involved here around 79, I would want to see it hold above 70, and then I basically, if it didn't do that, I would just basically take the loss in it of approximately 10 points. But then, like you said, if it did ever sink back below 60 or 50, well then I'd listen to you and see if the story changed and whatnot, and then I would try maybe buying it back off of much lower levels,
Yeah.
So, but yeah, no, it's a good one to keep on the radar there, especially if biotech actually does get some money rotating back into it. So, good stuff.
Yep.
And just so everyone is aware, Craig is Trend Tracker. Just wanted to make sure everyone could associate a name with a ticker. And just for sake of reference, so you know his style, he has no problem buying a dip on a stock that he plans on holding for a long time. I think just yesterday he got out of CIEN, a stock that he has held since 2017, and he still holds some of that position, but that unit he got well over 100%, almost 150% if I recall. So he's no stranger to holding things and understanding valuations, understanding the story, and willing to basically put his money where his research and his mouth is and hold these things. So yeah, good stuff from you, Craig. Appreciate your input on that.
Thanks, Jim. I think being a patient and disciplined investor is somewhat of a competitive advantage if you're willing to, hold a stock. Obviously, the market's been going up in recent years, so that helps. But I focus on the long-term fundamental picture mostly. So.
All right, and on that note, I think it's safe to say that we're all looking for some type of pullback, whether it's to find an opportunity to short the market or an attractive entry to buy. The question is, what are the risks associated with the market near term? Some type of specific catalyst or catalysts, if you will, that would give us a downward reaction. We could have the Fed, there could be something else. What's going to upset the cart here that might drive stocks lower? And I'll lead off with Chart. What do you think?
I think unquestionably it would be something related to the virus unexpectedly becoming a larger issue again. And I think this has been depth versus duration. I think if you take the idea that the picture looking ahead contains the idea that immunity really works, that we're going to have a vaccine on the near horizon, that there's this low K factor, in other words, that people can start to do more as long as they're not in particularly large and concentrated events. We've expanded our ICU capacity overall across, particularly in the United States. We've expanded our production of personal protection equipment. So we've really kind of guarded against the possibility of a large secondary outbreak. And I think that the messaging around that's going to stay conservative, but I think that some of the facts that if you do the research, suggest that this is something that is more containable than maybe we thought, certainly 2 months ago. If that picture changes back the other direction, that's certainly going to have an enormous impact. I think that the market will be able to look past initial behavior problems in consumers. So if people don't seem to be really completely going back to the way that they were before this very quickly, I think the market will be able to say, there's going to be this large fiscal stimulus component. It's going to remain in place, and eventually that pattern of behavior will start to reemerge. But I really think the big downside catalyst would be centered on the virus. Obviously, there's just trend exhaustion as a possibility. I mean, we've gone so far. You're going to have some pullbacks, and you're going to see a sentiment shift. We have short-term speculative momentum in the market. Certainly, the options data shows a lot of sentiment overreach. But if you look at larger sentiment indicators, larger time frame sentiment indicators, that picture is not nearly the same. You still have a full buy signal from the B of A bull bear indicator, which is looking at more cross asset flows and prime broker data on exposure. You still have a huge amount of money in the mattress. You still have a lot of people that are susceptible. I think that they've had I'm not going to participate in this rally kind of mentality of, I think, a lot of long-only, equity-only fund managers who have been kind of in the situation of self-anointed smart money status, that this is some speculative garbage on a liquidity squeeze, who are susceptible more and more to throwing in the towel on that philosophy and realizing that they're trailing their benchmark by so much they need to start chasing. I think there's a lot of support that can come in from elements like that. So I think a purely technical shakeout, a trend exhaustion shakeout, is one that's not going to be too sustainable to the downside. I really think you'd start to see, we've got the depth versus duration argument. If the duration again takes a step back in the direction that it's gone away from, but back in the direction of a very prolonged duration, the initial vaccine starts to look less likely. This narrative can shift again. And I think that's really the major downside risk, is this narrative shifts again to something where we end up susceptible to the idea that this is going to be a 2-year fight with a lot of lockdowns ahead. If there's any shift, even if that's not what's going to happen, if the mentality shifts back in that direction, if we start to get evidence that puts that risk back on the table, I think the market would obviously react extremely powerfully to the downside.
Yeah, blue chip here. So I just use a baseball reference. I would just say it looks like we're in a 7th inning stretch. The market's made a really great rally off the March lows and the April lows there. We've seen a lot of different rotations, a lot of good participation. A lot of breadth indicators, which is basically the advanced decline lines, the new high, new lows, put call ratios, etc. They have all been very extended to the upside on a short-term basis. So basically, like we said in baseball, 7th inning stretch, some people go home and leave, and then other people stick around to see how the game ends. And I think that's kind of where we're at right now, especially as we start entering what's usually the summer doldrums. And, people aren't really running out to beaches and whatnot and taking big, lavish vacations. So they are sitting around a little bit more on their computers, I think, over the summer and stuff like that. So we might continue to see more of a ranging sort of action going on here with a tendency to drift higher. But I do think that sector rotation is going to be the key thing going on here. I don't anticipate any aggressive drop, so to speak, in the market. But again, as Brett just said, how this virus plays out is really just going to be the deciding factor on I think on everything right now at this point in time. I think as we get closer towards the fall, when people are anticipating a second wave, you might see some selling pressure kick in, as well as with all the election rhetoric going on there. So people might be pulling money out, I'd say, around September or October, and maybe we just chop around here during the summer, and then we start to get a correction in the early fall months because of all the spikes and uncertainties and whatnot. But I think until then, we still have a good ways to continue drifting higher. 7th inning stretch, and still another 2 innings higher, I think.
Gavin, any risks?
I think Brett laid out the coronavirus risks. I would just note that Johnson & Johnson just had a pretty good headline about being an advanced development for their vaccine right now. That's why you're seeing J&J spiking up towards that 150 area. You certainly got a taper tantrum risk. I'd put that a little bit lower on the table because I don't think the Fed wants to step away, but that's something that we definitely need to continue to watch here. We've seen the markets in the past react violently to the downside anytime there's a hint that the Fed's going to take their punch bowl away. So, and I do agree with Brett's take that with the amount of money on the sidelines, any pullback could be very a steep drop. It could be pretty violent, but I do think that we would see people stepping in to defend it well above, say, the March lows. But I think the biggest risk to the markets and the most likely would be over the summer. We talked about the low-hanging fruit in the economy, where we're getting a big bounce back in, say, oil and things of that nature that are still low but look great compared to March or April. If we start seeing that flatlining, like we have been in China, where it doesn't suggest that you're going to just get a V-shaped recovery on the economy. We've talked a lot about how the market's a forward-looking instrument. If they all of a sudden start thinking that maybe they got a little bit ahead of their skis and this economic recovery is going to take a little bit longer, if we continue to see comments about linearity flattening out from the companies, things of that nature, then I think you're going to start seeing people reassess the valuation of the markets and start pulling in some profits here. So for me, I think it's just a flatlining of the economic data and earnings commentary from companies, and particularly on the employment side of things, if we see that start extending a little bit and we don't see a bounce back to the 2019 levels, then that could probably be the biggest risk to the market here over the next few months.
All right. Well, I think that wraps things up for us. I know we've got the Fed meeting in less than an hour, so I want to give everyone a chance to prep for that and get your lunch and all that good stuff. So I want to thank you, gentlemen, for getting us up to speed on everything that you guys are thinking about for the coming month or so. And guess what? We'll be able to do this again next month, and we'll see what has changed. I'm sure it'll be an interesting 4 weeks or so in trading. So I want to thank you all, and we will have a link to this afternoon. So if you did miss it, don't worry. You'll be able to get that under the ticker Audio X. Gentlemen, thank you.
Thanks, Jim.
Have a good one.